What is up, YouTube? Matt McKeever here, and today we're going to be talking about the mortgage glass ceiling. So this is something a lot of real estate investors, if you're brand new, maybe you just got into the game, when it comes to dealing with lenders, a lot of us have heard either whispers or maybe you've experienced some of the restrictions that the lenders, those are the big banks, the ones that you can likely name, the ones that have TV commercials, have when it comes to trying to scale your portfolio. So today, Josh and Aaron from the Findlay Mortgage team are going to break down for us a unique kind of approach where we can actually use B lenders in order to keep scaling our portfolio without necessarily having to become restricted the way the A lenders would.
Mortgage glass ceiling is a very real thing for investors who don't understand their mortgage options. The current climate right now specifically has asset prices increasing at such a rapid pace, whereas the rental income on these assets is no longer increasing. Such as also, most investors or most people who have a 9-to-5 job, your income also isn't increasing. So it's getting even more difficult to be able to get into these properties. So we've been able to find some solutions through like a multi-product approach to help people purchase units between 2 to 4 units on the residential side. And we kind of created this out of the need to be able to service debt, but also be able to get you into a long-term product and be able to scale it and do it multiple times over and over again once you kind of figure out your strategy and location to purchase.
Yeah, I think the biggest thing that a lot of people are starting to face right now, and one of the hurdles is looking at doing these huge improvements on the BRRRR strategy, where you might be able to get in and qualify on the purchase, but once you've raised that value of the property a couple $100,000, are you able to qualify then personally to be able to take that equity out? And if you can't realize that equity and take that out, you're no longer into the BRRRR method. You're just sinking cash into a property and tucking that away. So one of the things that we were focusing on is just how are we able to get somebody in, essentially maximize their personal debt servicing, saving on some of the fees and not having to go private, and then being able to exit out of that mortgage, realize the equity takeout, and this switch over from the B to the commercial is really one of the best options out there right now.
Yeah, and this specific strategy focuses on somebody who's probably maxed out on the A side. So somebody who, we take into a bank and you've been able to use all of your income to be able to purchase, say, duplexes, and you have a few of them. Your personal income is capped. You're hitting the glass ceiling. You can't go any higher. So how do you purchase more multifamily, or how do you purchase smaller multifamily, 2, 3, 4 units at scale? And this is exactly how you do it. So B lenders, as we've discussed before, have an amazing offsetting program, essentially meaning if you have rental income on your property you're looking to purchase as well as your entire portfolio, we can use a larger portion of the rental income and offset the cost or the liability on your application to help you qualify, which essentially spreads or stretches out your personal income to allow you to qualify for more. And this essentially allows you to be able to purchase more property more aggressively on the A side, or I'm sorry, on the personal side, not the A side. Now, usually there's some advantages and disadvantages to using these lenders. The disadvantage is they have slightly higher rates, so your carrying cost is going to be a little higher than what you would expect from a conventional A mortgage, although it is much less expensive than closing privately. Your fees are marginal, so you do have a broker fee and a lender fee involved, a lot less than what a private would cost you, and it's usually a 1-year term. So the B lenders do have multiple year terms, although the most cost-effective B solution is usually a 1-year term. It makes more sense for most people to take a single 1-year term at a lower rate than take a 3 or 4-year term at a higher rate, because you're paying that rate overall on the money, right, on your total loan amount. And the renewal fee is usually about $300 to $500. It makes more sense just to take a 1-year term and renew. The challenge is you're at the mercy of the market when it comes to renewing if rates were to increase. The specific strategy with purchasing with a B lender allows you to utilize either the rental income you have in your portfolio or the hypothetical rental income that we can use through either assuming tenants or through a fair market rent report that we can get before you purchase the property. So what you can do is you can utilize that rental income, get into a property that is underperforming. Say you're looking in like the Chatham area or the Kitchener-Waterloo area, and you want an A rate, but you can't qualify for an A rate on a triplex or a fourplex. Well, we would sit down and we would say, okay, what is your as complete value of that property when you're looking to finish your renovations? And then we'll reverse engineer it backwards. We'll say, based off your ARV value, a commercial underwriter is going to require you have a certain amount of revenue generated on that triplex to be able to qualify for a 75 or 80% equity takeout when it's complete. So based off of that, say you need $3,500 a month in rental income to be able to support that debt. We'll tell you you need that amount of rental income. You're going to create or finish your building based off of the finishes that you would require to be able to get that revenue in. And then once you do that, essentially we can transition you to a commercial product that has more flexibility, has a better rate, and allows you to be able to actually utilize a corporation, which would allow you to be able to scale and do this multiple times over and over again. Now, the advantage to doing this is, you're probably looking at some sort of secondary market. It's not going to really work in the GTA just because you're basing it off cash flow or off of the debt service coverage ratio. So you're looking at secondary markets or markets that don't have a really high cap to get in, but still have decently high rents.
Like Josh said, one of the best parts of doing this strategy is the ability to reverse engineer. So, one thing that we always talk about is making sure you're working with someone who's thinking about the long-term strategy as well too. It's great if you can get in on the purchase, but like I said on the BRRRR, you got to be able to take that equity out and realize that takeout. We can sit down ahead of time and go, okay, you're buying this for $5, you think it's gonna be worth $750 or $800, whatever it is. We can sit down and say this is exactly how much rental income you're gonna need, because the expenses are gonna stay relatively the same throughout the transaction. So having that insight knowledge ahead of time, we can figure out whether or not that makes sense. If you got to rent out, all 3 of your units at $2,500 or $2,800 a month, it's probably, you're probably stretching your likelihood of getting that refinance done at full loan to value. Whereas if you only need, $1,800 per month, that's pretty doable in today's market in terms of rental income. So, it gives you insight into what your end's going to look like, and if that goal is even attainable. I mean, there's sometimes it's an unrealistic BRRRR in terms of how you think the value is, and then that ability to be able to pull that out. The other great thing about commercial is there is no limit to how many properties you can have on the commercial side. So whereas with the A and the B lenders, you're going to get capped at some point, on the commercial side, you're going to be able to just scale unlimited amounts as long as your entire borrowing portfolio makes sense. You as a borrower have to make sense, and your properties have to debt service, but as long as those two things go hand in hand, there isn't really a cap on how many properties you can have on the commercial side. Another advantage of using the commercial lender on the takeout is that they don't have the same restrictions on the amount of equity that you can take out per transaction. Where when you get on the residential side, most lenders have a cap of around $200,000. If you're completing really large BRRRRs, you're probably going to have around at least $200,000 or looking to take out maybe a little bit more. On the commercial side, we've done equity takeouts of the multi-millions in that dollar figure. So, as long as you have a really good reason, or a semi-valid reason as to what you're going to put that towards, and you can just relay that to the lender, they're okay with giving you $1 million, $2 million in equity takeout. And again, just as long as everything makes sense. So the flexibility of a commercial lender as that end takeout financing really gives you a lot more options than if you were trying to refinance back into a residential lender. Then it just frees you up to be able to have a much more smooth transaction and make sure you're able to move on to your next purchase a lot quicker.
Yeah, we find that this strategy is usually people who have purchased a few single-family homes or maybe a duplex and are looking to get into a larger unit building, but not quite jump into commercial financing. It's kind of like this weird limbo stage where people are dipping their toes in the water to see if this is something that they would like to endeavor. So you can utilize both conventional and commercial financing to get this strategy done while still not having to maybe increase your T1 number and pay more taxes on paper. So it's a really great strategy. It does utilize a little bit of down payment, and there are some upfront costs to do it, but it's a lot more effective than being able to have to close privately on on a property that's underperforming. Now, something to keep in mind is this doesn't necessarily negate the condition of the home. So B lenders still require that there is a certain livable condition. So if you are purchasing a property that is maybe off market, that's in disrepair, or isn't in the best shape, this isn't going to work. B lenders still have minimum requirements when it comes to that. So if you're looking at like really tough properties, you're still going to have to utilize the private. But if you're looking at properties that just need cosmetic work and you can go in and just do a bunch of renovations and turn over the property, then this strategy is amazing and will allow you to be able to scale indefinitely as long as you follow the specific strategy.
Awesome, guys. Really appreciate you breaking it down for us. And I think one last point just for everyone at home to remember, if you're looking at executing or maybe implementing this strategy, is you need to take a big picture approach here. So for a lot of newer investors that maybe have 1 or 2 deals that have been financed up until this point with 8 lenders, you probably are going to be looking at a little bit more in additional costs, right? But this is where the big picture comes into play. A lot of people will literally sacrifice their future in order to have a slightly better deal today, but that's going to actually hold you up. And the sacrifice here when you're dealing with only 8 lenders is your ability to scale. So this strategy is really designed well for those of you that want to actually acquire multiple properties in the near future. Again, with 8 lenders, there's just such a restriction there, a glass ceiling, as Josh was saying. So really appreciate you guys breaking it down for us. And a reminder, if you guys want to reach out to Josh or Aaron, all their contact information is in the video description down below. Really encourage you guys to reach out. And again, sometimes when we're dealing with these scaling strategies, when we're dealing with transitioning from A lenders to B lenders, it's really valuable to reach out early, proactively, get an understanding, because again, this is going to be new territory for you. So it's important that you understand what you're getting into before you've got the deal signed, before you're like 24 hours away from waiving financing conditions. And again, a lot of us real estate investors have a tendency to procrastinate, so don't procrastinate on reaching out to Josh and Aaron. Thanks, guys.